On today's Squawk Planner, key inflation data ahead. We'll get the November read on consumer prices at 8:30 a.m. Eastern, and poll forecasters expect an increase of 0.3%, and that would be 2.7% year over year. Today's CPI, and then we get PPI tomorrow. The final reads on inflation before the Fed's December meeting, which is next week. Joining us now, Kevin Cummins, chief U.S. economist at NatWest Markets. That's a pretty good number. Is that a friendly number if it's 2.7, 0.3, Kevin?
Yeah, I mean, I think that sort of number really probably doesn't change the odds of 25 basis point expectation for the Fed next week. It will be, some members of the FOMC will certainly look at it as a stalling out of progress that they've seen in the deceleration in core. This will be, if we get a 0.3 rise in the core, that'll be the fourth straight month. And the prior 3 months, you had gains of either 0.1 or 0.2. So we've seen inflation reaccelerate a little bit over the course of the last couple of months here that, I think it would signal kind of a hawkish cut by the Fed next week. And probably dial their expectations back for how much easing that we're likely to see next year.
Well, maybe that's warranted at this point. 2.7, Kevin, is not 2. I know that, and it sounds like, when we talk about most things, who's going to quibble with 0.7%? But that's like 35% higher than when the Fed wants, and it's on top of what's already in there from, when we were at 40-year highs a couple of years ago. So, I mean, prices are still rising above what the Fed wants. So do you think the labor market is showing enough signs of softening to where we need the cuts? The stock market certainly doesn't act like it needs cuts.
Yeah, I mean, I think there's a lot of uncertainty with regard to the labor market. So far, we've seen a pretty much the Fed's expectation for a soft landing come to fruition. The data have held up pretty well, both on the growth side. The labor market, last week's labor data, you did see a tick up in the unemployment rate. And it, if anything, it almost rounded up to 4.3%. It was just a whisker away from that. So, I think the Fed's got to be pretty careful. As of September, the last time we saw the Fed's dot plot, it did show 100 basis points in cuts this year. So I think they will follow through. I mean, markets at this point are pricing in almost, 85 to 90% odds of another rate cut in December. But the inflation data should give policymakers some pause here as we go into 2025. So I think that's kind of their base case now, is to dial back the expectation of how much easing next year. I mean, as of September, they showed 100 basis points in easing for an expectation of next year. I would think they'd probably cut that into about half. So they would only show maybe 50 basis points in cuts next year. And I guess, there's obviously a lot of rhetoric on the campaign and in the wake now of President-elect Trump about tariffs. So that's another consideration for the Fed, that they, should be pretty watchful here with regard to inflation. That, it may be temporary, and it may be an effort to negotiate with other countries. But, if anything, tariffs are a tax on consumers, and prices will move higher. So, there's a lot of uncertainty with regard to how much, and it is temporary, but they need to be careful here. And I think that, opens the door to maybe a pause in the first quarter of next year. But, we'll see how the data come in. If it allows them, which so far it has, you don't have to go back very far when the Fed was expected to be kind of aggressively cutting, moving down toward a more neutral stance. And obviously markets have repriced a lot of that because the inflation data have remained stickier, and the growth data have held up and allowed them to kind of feel their way probably more gradual than most expected a few months ago.
Kevin, there's a strategist. I mean, there are, I can name 4 really significant policy initiatives or uncertainties that were kicking around that are going to happen after January 20th, I don't see how you can make any determinations about anything as the Fed or as a strategist. And I'll tell you which ones I'm talking about. I mean, I don't know what deportation looks like or the immigration issue. I don't know how that plays out. You mentioned the tariffs already. Talk about Elon Musk and Vivek Ramaswamy and Doge, and then just talk about the extension of the tax cuts. And it's not divided government. Every time pre-election, every person who comes on says, well, I'm optimistic that, it's going to be divided government, so nothing. Well, it's not divided government. It was a sweep, even though it's a narrow margin in the House. But you've got one party that's going to be able to basically perhaps do what it wants to do. These uncertainties, they don't make you nervous at 22 times earnings?
Yeah, I mean, I think one level of uncertainty was replaced because we know the outcome of the election. And now it's been replaced by, there's, as you mentioned, there's concerns about immigration, about tariffs, and the overall outlook in general going into any year. There's always a lot of uncertainty. And then you layer those in. I mean, there's always pluses and minuses. So I'm not only worried about downside risks to the economy from any sort of hit to growth or to inflation from this. There are offsets. In the last time Trump was in office, oil prices averaged somewhere around $50 a barrel. So you will have some potential offsets to, let's say, for example, there is, a 60% tariffs on Chinese imports. That'll certainly filter through to the core inflation data and to headline inflation. But then, if a more energy-friendly policy and administration, if oil prices were to go down, that's going to offset some of that. So there are a lot of, possible pluses and minuses when looking at this to consider. There's a lot of discussion about a much friendlier business environment, less regulatory policy.
All these offsetting,
so that could be a plus as well. So,
right.
But to your point, the level of uncertainty is, and we've seen it, in policy uncertainty indexes are up. They're up in Europe as well. So, there's more uncertainty going into a new year than there's probably been ever before in the last several years.